In today's video, I want to talk about some of the best performing and also some of my personal favorite high-yielding dividend growth stocks. When it comes to investing for dividends, there's two different methods that need to be defined first. The first and most popular type of dividend investing is known as dividend growth investing. This involves investing in stocks, ETFs, and other funds that offer lower dividend yields but offer consistent share price growth and dividend increases over time. The second type of dividend investing is referred to as income investing. This strategy involves investing in stocks, ETFs, and other securities that offer much higher dividend yields but typically offer no growth in share price or distributions over time. For these investors, most of the growth you'll experience will be by reinvesting your dividends into buying more shares of the same holdings. It's not uncommon to see people pursue both types of dividend investing, and I myself invest in both growth and income holdings. But for this video, we're going to be exclusively looking at dividend growth holdings. These are the investments that I own that I rely on for long-term growth, both in share price and dividend distributions. And as you might know, if you watch my videos on a regular basis, I specifically target investments that offer a yield of at least 4% with one exception. So today what I wanted to do was go over some of my favorite holdings that I rely on for growth in my own portfolio. Next week, I'm planning on going over some of my favorite income holdings, all of which I'm currently reinvesting my dividends in so I can keep buying more shares of. So with that being said, let's go ahead and get started. To start things off, the one holding that I recommend every dividend investor holds, regardless of your strategy or life circumstances, is SCHD. This is the only holding that I own that yields below 4%, and I buy it under all market conditions. SCHD is the Charles Schwab US Dividend Equity ETF, which tracks the Dow Jones US Dividend 100 Index. It's a diversified fund that's offered long-term growth both in share price and dividend distributions. Since being launched in 2011, SCHD has kept growing its quarterly dividend very consistently. It varies from quarter to quarter, but it always moves upward over the long term. It currently yields around 3.3%, which is still better than a lot of other dividend stocks like Sherwin-Williams or Home Depot. It also charges a very low expense ratio at just 0.06%. There's a lot of other diversified dividend growth ETFs to choose from, including some from Vanguard, like their High Dividend Yield ETF or their Dividend Appreciation ETF. There's also some that offer monthly dividends instead of quarterly, but after looking at a lot of them, they don't match SCHD in terms of growth, dividend appreciation, and a low expense ratio. According to ETF.com, last year SCHD saw the highest amount of inflows for any dividend ETF, and they were also the fourth most popular ETF in the country with over $15.4 billion worth of inflows. Ultimately, it doesn't matter if you go with SCHD or maybe one of Vanguard's ETFs, just having at least one diversified dividend growth ETF I think is a great bedrock investment for any dividend investor. Next, I want to talk about some real estate investment trusts that offer some higher yields and good growth. My favorite REIT, if you don't know already, is Realty Income, which is ticker symbol O. I discuss this stock all the time, so I'm not going to focus too much time on it. But Realty Income's a monthly dividend-paying stock that owns more than 11,000 properties and have declared 632 consecutive common stock monthly dividends throughout its 54-year operating history. It's a dividend aristocrat, meaning they've been able to grow their dividends every year for at least 25 consecutive years and counting. In fact, they actually just raised their dividend last week by another 2.4%, which was great. This stock's often referred to as the monthly dividend company, and over the decades it's continued to do really well. It currently offers a yield of around 4.62%. Another REIT that's kept doing really well is WP Carey, ticker WPC. Celebrating its 50th anniversary this year, WP Carey ranks among the largest net lease REITs with an enterprise value of approximately $24 billion and a well-diversified portfolio of high-quality, operationally critical commercial real estate. WPC recently joined Realty Income as a dividend aristocrat. In fact, their stock has been able to grow its dividend every single quarter for more than a decade. With a strong occupancy rating, a well-diversified portfolio of properties, and a good track record, WPC is another one of my favorite REITs. It offers a higher dividend yield than Realty Income at roughly 5.09%, but they haven't been as aggressive in growing their dividends as much as Realty Income has over the last few years. But still, it's a good growth holding worth considering. Vici Properties, ticker symbol VICI, is a growth stock I've been becoming a much bigger fan of over this past year. They're an experiential REIT that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations. This company owns some of the best properties on the Las Vegas Strip, including Caesars Palace, the MGM Grand, and the Venetian, among many others. It's a much younger company with not as long of a track record as what we've looked at so far, but as I just talked about this company last week, it does have a lot of pros to it. They have an average lease term of 42 years, and they're able to increase their rent on their properties at a much faster rate than other REITs. Not even the pandemic could slow down this company's growth, and over the last year, their stock has outperformed the market by a huge amount. It's not one of my largest holdings, but I plan to keep buying it more aggressively. One more REIT I'll mention that I own of to provide me with a little bit of growth is Stag Industrial, ticker STAG. This REIT focuses on the acquisition and operation of single-tenant industrial properties throughout the United States. As of December 31st, this company has 562 properties located in 41 US states. Additionally, the stock pays monthly dividends just like realty income. However, Stag Industrial is the lowest yielding company on this list besides SCHD, and they've also been much slower in terms of growing their dividends. Their stock recently recovered so much in share price that it briefly dipped below 4% in terms of a dividend yield. But up until this point, they've continued to experience growth, especially with their share price. It's one of my smaller holdings, but it does provide me with a little bit of growth still. Let's take a look at some business development companies. Most BDCs don't experience consistent growth in terms of share price or dividend increases. For these stocks, nearly all the growth you'll experience will come from reinvesting your dividends. But there are a few that I do like that do provide some good growth, so I'll mention a couple of them. Hands down, the best BDC when talking about growth would have to be Main Street Capital, ticker MAIN. Since their inception back in 2008, this company has never reduced their dividend, and they've probably grown it more than any other BDC out there. You can see their dividend amount has grown by roughly 105% since their IPO, and they do pay the occasional special dividend every now and then. It currently offers a dividend yield of around 6.7%, which is much lower than your typical BDC, but the reason for this is because it always trades at a premium. Investors are just willing to pay more for a higher quality stock. So overpaying for a stock isn't always a bad thing, especially if it's been a consistently great performer for many years. Over time, the share price for Main Street Capital has also grown really well. It's typical for most BDCs to see little to no share price growth over time, but since Main stands out among the pack, they've actually been seeing quite a lot of share price growth since their IPO. It's a well-diversified investment, and to this day, it continues to be one of my favorites in this sector. But besides Main Street Capital, there really isn't another BDC out there that really stands out for its impressive long-term growth. There are a handful of BDCs that have been growing more recently due to higher interest rates, but for the most part, these companies offer dividends that can go years without being increased. But there are some BDCs that have been growing slowly and outperforming most of their peers. The first one I'll mention is Ares Capital, ticker ARCC. I've talked a lot about this company over the years because it's currently my favorite BDC. It's the largest BDC in the industry, and they've been really aggressive in the last few years of growing their dividends. It currently pays 48 cents per share, whereas back in 2020 it was only paying 39 cents per share. Its share price has also seen some growth, but not nearly as much as Main Street Capital. But considering it yields almost 10%, that's still a decent amount of growth for something that pays that high of a dividend. Another BDC that's grown really well since the 2008 financial crisis is Hercules Capital, ticker HTGC. Since 2010, their stocks more than doubled their dividend distribution amount, going from about 20 cents per share to now about 47 cents per share. So this stock actually has grown their dividends faster than Main Street Capital, but they did take a massive hit during the financial crisis. You can also see they don't pay the same dividend amount each quarter, but they do offer a lot of special dividends, which is nice. But over time, the amount they pay on average keeps increasing. Their share price has also grown a little bit over time, again not much, but for a BDC, it's still a good amount. When you take reinvested dividends into consideration, Hercules has outperformed the S&P 500 by a pretty sizable amount. Since 2005, it's provided an average annual return of 11.8% compared to SPY, which has only given a 9.15% average return. I say only like it's not really a great amount, but it actually is pretty good. It's just Hercules Capital has done better. And that's going to wrap up our look at some higher yielding dividend stocks that have provided good growth over time. There are some more out there that I own that do yield over 4% and offer growth, but the ones I just talked about are some of my favorites. Next week, I'm going to discuss some of my favorite higher yielding income stocks that don't necessarily offer growth other than if you reinvest the dividends, but they offer much higher yields on average. With that being said, thank you all so much for watching today's video, and be sure to click the like button and subscribe if you want to see more of this type of content. Again, thanks so much for watching, and until next time, take care.